The smarter way to play big tech, a deep dive into QQQM. Welcome back to the show. Today we are answering one of the most frequent questions that hits our inbox. If I want to invest in the NASDAQ 100, which ticker should I actually buy? For decades, the answer was simple. Ticker QQQ. It was the gold standard, the triple Q, the titan of tech ETFs. But a few years ago, a new player entered the arena. QQQM, also known as the QQQ NASDAQ Next Gen, or more simply, the NASDAQ 100 ETF. Today, we are going to break down every single detail of QQQM. We'll talk about why it exists, why it's often a better choice for your retirement account than the original QQQ, and how it manages to give you the exact same companies for a lower price. This is the 1,000-word masterclass on QQQM. The origin story. Why does QQQM exist? To understand QQQM, you have to understand its older brother, QQQ. The original Invesco QQQ Trust was launched in 1999. It's a unit investment trust, which is an older legal structure for funds. Because it's so old and so massive, with hundreds of billions of dollars in assets, it became the primary vehicle for institutional traders, hedge funds, and day traders. However, QQQ carries an expense ratio of 0.20%. While that's low, the modern world of ETFs has moved toward even lower costs. Invesco realized that long-term buy-and-hold investors were starting to look for cheaper alternatives. They didn't need the massive daily trading volume of the original QQQ. They just wanted to own the NASDAQ 100 as cheaply as possible. Enter QQQM in October 2020. It was designed specifically for the retail investor, the person who contributes to their portfolio every month and plans to hold for 10, 20, or 30 years. The math of the expense ratio. Let's get into the nitty-gritty, the cost. The headline feature of QQQM is its expense ratio of 0.15%. Now, on paper, the difference between 0.20% for QQQ and 0.15% for QQQM seems tiny. It's only 5 basis points. But as we always talk about on this podcast, compounding works both ways. When you are investing hundreds of thousands of dollars over several decades, those 5 basis points start to add up. For every $100,000 invested, you are saving $50 a year. Over 30 years, with market growth, that translates to thousands of dollars that stay in your pocket instead of going to the fund manager. If you are a long-term compounder, why would you pay more for the exact same product? Under the hood, what do you actually own? One of the biggest misconceptions is that QQQM holds different stocks than QQQ. Let's clear that up right now. They are nearly identical. Both funds track the NASDAQ 100 index. This index is made up of the 100 largest non-financial companies listed on the NASDAQ stock exchange. This means you are getting the Magnificent Seven and then some. You own the giants of the modern era. We're talking about NVIDIA, which has become the backbone of the AI revolution. You own Microsoft and Apple, the two pillars of software and hardware. You have Amazon for retail and cloud, Alphabet for search, and Meta for social media. But it's not just tech. A common mistake is thinking the NASDAQ 100 is a tech index. It's actually more of an innovation index. You'll find Costco in there, which is a retail powerhouse. You'll find PepsiCo and Mondelez for consumer staples. You'll even find biotech and healthcare innovators like Amgen and Intuitive Surgical. The only thing you won't find are banks and financial institutions. The structural difference, ETF versus UIT. While the stocks are the same, the legal structures are different, and this actually matters for your dividends. As mentioned, the original QQQ is a unit investment trust. This structure is a bit rigid. For example, QQQ cannot reinvest dividends back into the fund's underlying stocks. It has to hold them in a non-interest-bearing account until they are paid out to you. QQQM, however, is a modern ETF structure. This allows the fund more flexibility. It can participate in things like securities lending, which can generate a tiny bit of extra income for the fund to help offset its expenses. It also means that QQQM's dividend yield is often a tiny, tiny bit higher, around 0.6 to 0.7% compared to the original. Again, it's a small edge, but in the world of long-term investing, small edges are everything. The tax efficiency advantage. Let's talk taxes, because that's where the hidden returns are often found. Because QQQM is a newer ETF structure, it is incredibly tax efficient. Since its inception, it has almost never paid out capital gains distributions. In a traditional mutual fund, if the manager sells a stock for a profit, you might get hit with a tax bill even if you didn't sell your shares. Modern ETFs like QQQM use an in-kind creation and redemption process that allows them to wash away those capital gains. For an investor in a taxable brokerage account, this makes QQQM an incredibly clean holding. You only pay taxes when you decide to sell your shares. Liquidity, the one area where QQQ still wins. Now, I've spent a lot of time praising QQQM, so you might be wondering, is there any reason to ever buy the original QQQ? The answer is yes, if you are a trader. Because QQQ has been around since the 90s, its liquidity is unparalleled. The bid-ask spread, which is the difference between the price you buy and the price you sell at, is razor thin on QQQ. If you are moving millions of dollars in and out of the market every day, or